Welcome back to Theya. I'm Joe Consorti. Today I'm here with a longtime friend of the show, James Lavish. He is a managing partner at the Bitcoin Opportunity Fund and the author of the Informationist newsletter. James, how you doing?
I'm good. How are you, Joe? Good to see you and good to be on here. We haven't talked in weeks, it seems.
Weeks indeed. Yeah, no, it's markets are really crazy right now. So wanted to have you back on the show to discuss some of the things. So we'll dive right into it. Most pertinently is the recent auctions in the US Treasury market. The US Treasury has obviously been raising its issuance of debt, this being an election year, and also next year's budget is pretty out of control. So we've had increased auctions, and the last couple of them have been pretty dismal. You put out a tweet discussing it. First, we had the 10-year auction, then we had the 30-year auction. Both were pretty bad. So talk to us about what happened there.
Yeah, I mean, we're watching in real time, Joe, the Treasury. So let's back up. People blame the Treasury for all this, but really it's the Treasury doing the bidding of Congress. You know, Congress is the one that's spending just recklessly, right? They're the ones who are determining what the budget is and using these fiscal deficits and we're operating with a fiscal deficit which is unbelievable. It's how big it is right now. Considering we're not in war, we're not in a recession, and we're running $2 trillion deficits. And this is it's kind of astounding that we're 6 to 7% of GDP here. This is nuts. But in order to facilitate that, the job of the Treasury is to make sure that they enable the spending and whatever the congressional budget is, and they have to then borrow in order to do this because we're not making enough money. I mean, obviously, like this is a great chart. Exactly, you can see that deficit is just growing. Yeah, if you just ignore the 2020 drawdown there and just look at the trajectory of these deficits, and each time we hit a tough period, you can see there in the mid 90s, and then again in 2008, and then again in 2020 or when March of 2020, and now you can just see it's just on that trajectory down to the right, bottom right of the quadrant, not the right place to be. So, but the issue here is that the Treasury has to keep borrowing in order to pay down debt that matures and to pay off this deficit in order to keep the government running. And as they're doing that, we've seen over the course of the last 6 months, we've seen a number of auctions that have gone a little bit awry. And what I mean by that is, look, it's not, there's no way that we're going to have you know this, but for your listeners, there's no way we're going to have a U.S. Treasury auction that just fails. That would be catastrophic. It would take the entire financial system of the world down. I mean, the U.S. Treasury is the global reserve asset, and it's because we operate on the global reserve currency of the U.S. dollar. So, but what we've been seeing is a little bit of dysfunction. And that dysfunction comes in the form of less liquidity than there should be. So there should be quite a bit of liquidity in these offerings, and sometimes there's less than expected. We go back to November. There was a 30-year bond auction that was absolutely abysmal. And what had happened is the size of that issue was larger than the street expected. So it had a large tail. It didn't have a great bid to cover. But the real concern is that foreign buying was lower than expected, which meant the dealers were left with more of the issue than expected, and then they have to turn around and find pockets for that later on after the auction and resell it out to the street somehow because now they're sitting on all of it. So if you can imagine, these auctions are kind of like if you were having an art auction at Sotheby's, and at the end of the auction, if you didn't get the bids you wanted or needed, then you just said, well, Sotheby's, you have to buy this art from me at this price. And that's just the way it's going to be. And then Sotheby's is sitting there with all this art that they did not expect to have. Well, that's kind of what happens in these auctions with the primary dealers. They have an agreement that they're going to make a market for the Treasury to make it orderly. And if they have to buy the rest of the issue in order to get the price the Treasury needs, then so be it. That's what's going to happen. And that's what's been happening here and there. We saw a 30-year auction that was poor. We saw a 20-year auction that was poor. We've seen a 10-year auction that's been poor. And so over the course of the last number of months, you're seeing these problems creep up. So going to the auction you're talking about last week, we had a surprise number in the CPI. Not really shocking to you and me. We're watching all of this liquidity pour into the market, and we know that there's perpetual high inflation that they're trying to hide, but there's only so much you can hide, and it does come out in the wash sometimes. You have these readings that are that it's clear that we have sticky inflation that's above 3%, and so the market didn't love that, and so you had this 10-year auction just last week that, if you go through the numbers, had a 3.1 basis point tail, which you and I just discussed right before the call, and that's versus a less than 1 basis point average over the last 6 auctions, right? And so that's a big deal. And why is that a big deal? Because the tail is telling you the difference between the final yield, the high yield of the auction, the final yield, and the when issued market. So these bonds will trade pre-market when issued, leading up to it for a number of weeks, and that they'll have a yield that has been settled in that pre-market, and if you compare that to where the actual auction was, you want them to kind of be right and about the same as each other, because then expectations kind of meet what reality is. But and that's called, if it does have the same exact yield, that's called on the screws. It just, the auction made out exactly like people expected. But when you have a tail, that means that the Treasury had to offer a higher yield than expected in the pre-market. So if you imagine a 30-year auction, a 30-year bond, that if you have a 3, 4, 5 basis point difference over the course of that 30 years to maturity, that's a massive amount. So it's a really big deal for you to have that big of a tail. So three basis point tail on the 10-year, which is that's the benchmark Treasury of the world. So we have the global reserve asset, the US Treasury. The 10-year is the benchmark. And so this is the one that everybody's looking at. You had a terrible tail. Foreign bidders dropped to 62%. That's the indirect bidders. And then the bid to cover was just 2.34, which is the 2.34 of the 234% of the bonds were bid for versus about 252%, and so that was pretty bad. And so if what you end up with at the end of the auction is the primary dealers were stuck with 24% of it. I mean, it's like almost double what they were saddled with back in just February, just 2 months ago. And so they're all standing around thinking, God, the market didn't even want these things. And so it's a little bit of a shock. Was it catastrophic? No. Was it abysmal? Absolutely. It was an absolute terrible auction. And people are going to be watching the next one very closely. And I would expect that the Treasury is going to be talking to the dealers, talking to the banks, and making sure that there's enough demand at the right price leading up to the next auction.
Which is a very
That was a long answer, but
it was excellent. And for the readers, for the viewers rather, sorry, I'm in writing mode. There's a lot of utility in that because not a lot of people understand auction talk and auction language. I have a chart here that kind of illustrates just how bad it was. So this was following the CPI print. This is the one-day change in the 10-year yield. Following the very bad auction and also the huge sell-off that happened, this was the third biggest spike in the 10-year yield since the COVID sell-off. And if you go back even further than this, you don't see this kind of sell-off all that frequently in the world's benchmark global reserve asset.
No, you don't. And that's what's so worrisome. So people are saying, well, what is that? Why is that happening? Well, there's a number of reasons. Sticky inflation means that investors they're going to want a higher yield for their investment because they expect that inflation will eat into that yield over the course of the life of this bond, and they want to be protected against that. They also want to be protected against even higher inflation, especially because we're seeing how difficult it is for the Fed to control this. They got it down by raising rates so rapidly. They did get it down from 9% down to 3 some odd, according to the measures that they use. You and I both know that that's a little bit hogwash, but they did get it down. And so what's the issue here? Well, the issue is, and we've been talking about this for months now, is that we are operating in a fiscal deficit. The government is spending so much money that it's inflationary. They're spending so much money they're spending over $1 trillion, almost $1.1 trillion a year just on interest on the debt that they owe. That's just going out the door from the Treasury, from the government, from our tax dollars, which not really because they're spending more than the tax dollars, just going out the door into banks' pockets, into investors' pockets, and that turns around and it ends up, creating service inflation, right? So, and asset inflation. And there it is. The government expense is it's absolutely parabolic. Well, why did that happen? Because we're running at deficits. We have over $34 trillion of debt that we're managing in the U.S. And when you raise interest rates from just about 0 up to 5.5%, you're going to have a larger interest expense. It's just like if your credit card, or if you go back to 2008, why did that happen? Why did we have the great financial crisis? Because the floating interest rate debt, those floating notes, went from just a few percent up to into the teens, and it just destroyed those homeowners that couldn't make those interest rate payments because they were multiples of the original mortgage payment, and so they collapsed because of that. So we're seeing the same thing happen now in commercial real estate, but it's kind of a double whammy because you have commercial real estate and office real estate in particular that has been impaired because we don't have everybody coming back to work. So when you have an office building that has 40% to 60% fewer occupants, well, it's worth less because you have less demand for it. And so you can't charge as much per square foot on those floors, and you can't meet those debt obligations. And so now you've got some banks who are just walking away from, or some investors who are just walking away from these and handing the keys back to the bank. So this all feeds into all the confusion we have going on in the economy right now. You are seeing pockets of recession in areas, but you're seeing pockets of expansion. So you've got recessionary indicators in parts in areas of the economy that are interest rate sensitive, commercial real estate, or technology that requires debt to be serviced as they increase their research and development, and they're trying to get product to market, and they're borrowing to do that. But you're seeing on the other side that you've got certain travel and leisure and infrastructure, with the Inflation Reduction Act has been quite inflationary because we're spending all this money on
airline
infrastructure
travel
and
was
green projects.
in Q1 was the highest in the last decade, something like that. Completely insane.
Yeah. It's completely insane. You've got boomers who are, every time you go onto a restaurant, it's absolutely packed solid. I was just out in Austin this past weekend. It was nuts how busy it was. So the planes were full, the airport was full, the restaurants were full. And sure, it's Austin and it's doing well. It's in Texas. It's got a lot of technology that's doing well, and it's a university town. But it was actually pretty impressive how little that area is feeling any economic pain, if any. So, but that's why you hear people who are confused are saying, "Well, I don't understand. Like, how how do the unemployment numbers, how do those foot if you're hearing of people who are who are being laid off. You're seeing tens of thousands of people being laid off from these technology companies, and yet they're showing a unemployment rate that's not really rising. It's still stuck under 4%. And so, how is this really? How is this working? Well, when you can see the household number is different than the establishment number, right, Joe? And you and I think we've talked about this before, where the household number is if you're a surveyor, you're at the BLS, right, your Bureau of Labor Services, and you're making phone calls to people, and you're saying, hey, how's your job situation? And you say, yes, I've got a job. I am employed. Are you employed or not? Yes, I am employed. Now, you may have 2 or 3 jobs that you're working. Then they go and they call all of the establishments. And first of all, if you're an establishment that's struggling, you're not going to pick up the phone. You're in survival mode. You're not going to pick up the phone from some surveyor and take 15 or 20 minutes to do a survey for the BLS. You're focused on the job and making sure your company is surviving. So it has a little bit of survivorship bias there. But secondly, if you ask them, you can say, okay, you ask the person in the household, are you employed? Yes, I am. Well, they may be employed at both Chipotle and McDonald's, but you go and call Chipotle and they say they added a job. You call McDonald's, they say they added a job. Well, now you've got 2 jobs you added versus the household, which is just 1. They're employed. They're expanding their employees by 2, so they don't foot. Why? Because people have multiple jobs. It's
It's at an
it's stuff
all-time
like
high, by
this.
the way. It's an 8.5 million people who've reported, and in the month of March, part-time jobs rose by 700,000, while full-time jobs fell.
That's crazy. Like think about that, right? So you've got the White House or the administration, and both administrations do this nonsense. It's not just because I'm apolitical. I think they're all snowing us, but it's their job to say everything's going great. Inflation's coming down. Inflation's not coming down. It's just going up at less steeply, at a lower rate. Prices are still rising though. So there's just a lot of confusion and misinformation, disinformation, and that's why you have a lot of people who are confused about this. But the one thing that we can do, and I love that you hit on this right out of the gates, is watch the bond market. Don't watch the stock market. I mean, don't even watch Bitcoin. Watch the bond market. If you want to know what's really going on, watch the bond market, because they have they literally have the first lien on everything. And so that gives you a pretty good indication of what's going on in the economy in the world.
100%. It's the asset that underlies all of global commerce. It's the biggest asset that exists on the balance sheet of every major financial and non-financial institution. You're 100% right. And in that vein, I want to ask you about this huge correlation break. You put out a tweet saying that there will be signs. Zero Hedge put out a chart between the spot price of gold and real rates, which historically have had an inverse correlation because both are supposed to reflect inflation, price inflation, that is. But since 2021 here, actually in December, almost perfectly, huge divergence here. They've broken their correlation. Gold is rocketing towards new all-time highs, and real rates are rising. Real rates at 2.17%. How does that make any sense?
Right. Well, I mean, what you're seeing here is gold is sniffing out the fact that the Treasury has no choice but they're going to have to issue massive amounts of debt, massive, and gold is kind of sniffing that out here, and so it's kind of breaking loose, and you're seeing foreign central banks are adding gold to their balance sheets and not really treasuries as much. They're backing off their treasury additions. It's not like they're selling treasuries actively. They're not. They're dumping treasuries and buying gold. I don't believe that that's happening. But you are seeing that these large it's non-U.S., non-European, but central banks are out there buying gold. And they know that gold can hold its value and they're worried that, for a number of reasons, when I think you make a tactical mistake when you show the world that you can turn off their money supply. If you go and turn off, like we did, Russia's treasuries, we seize them. We say you cannot use these assets. We turn off their SWIFT payment systems. They can't access that. That makes anybody who's not one of our close allies, and maybe even some of our allies, take notice that, if I own treasuries, that could be problematic. However, if I own gold, they can't really touch it. It's in my vault, and I can use that. And honestly, it's a great hedge against inflation of the U.S. dollar. It always has been, and so long term. And so I think that's what you're seeing. The signs are that people are worried that the Treasury is losing a little bit of control here, because the government just refuses to back off. And so we've talked about this ad nauseum, that we are already in a debt spiral. The math is clear. It's not even something that is outlandish to suggest anymore. We've seen the Congressional Budget Office put out reports. We've seen that show the trajectory of the U.S. of the debt and debt to GDP, that it's just rising exponentially. This is the path we're on. The Treasury put out a report last year that was subtitled "An Unsustainable Fiscal Path," and it showed that the debt to GDP rising exponentially. And then even Powell said it on 60 Minutes. He said, well, I can't tell the Treasury what to do. I can't tell. I work for Congress, but I can tell you that we're on an unsustainable fiscal path. Unsustainable fiscal. What does that mean? So people hear that and they say, oh, well, that just means that we have to change direction. Well, that means that we have to spend a whole lot less, or we have to tax a whole lot more. And if you raise taxes, they all know this. If you raise taxes, it winds up hurting productivity. So what happens is you take money away from areas and companies that are doing well, that can invest in research and development, create new products. Yeah, there it is. I mean, that's exactly that's our trajectory. That's where we're headed. And so,
And
what are your choices? Yeah. Right.
it's,
So
you either raise taxes and you cut spending at the same time and induce a multi-year recession, or you let it happen and you let price inflation run hotter than interest rates. Do I have it
there
about
it
right
is.
there?
There it is. So so let's talk through that, because if you you could either cut spending, which nobody's going to do. Neither party is going to really cut spending in earnest. What are they? And really where you'd have to cut is Social Security. You'd have to cut entitlements. Who wants to do that? That's a lot of votes. It's political suicide. They don't want to do that. But what the other idea that a lot of people have is just raise taxes. Just raise taxes. Well, if you raise taxes, you wind up hurting productivity in the long run, because you hurt investment in new product lines, investment in profitable product lines, investment in new technologies, in research and development. And so long term, you have higher taxes on lower productivity. And so you get to the same spot, but you're at the same spot and it's even worse because productivity is going down. It's in a downward spiral. And so you don't want to do that. And they know this. And so your third option is to just issue more debt, which is what we're doing, and allow for inflation to run hot in order to create fake GDP. That's all it is. It's your dollars are worth less in the future. Well, this is what these foreign banks are sniffing out. There's a danger that their assets could be seized or turned off. And then there's a danger that they're not going to be worth as much as they need them to be in the future, and so they're buying gold, and that's a big sign. And that's problematic.
It's extremely problematic. I want to shift gears here very briefly to CPI. We talked about very briefly with the U.S. Treasury's huge fiscal deficit that it's running. We've kind of become entrenched at this 3.5 level. Obviously, you and I know that price inflation is much, much, much higher than the reported numbers. But we've been here for 10 months in a row at 3.5%. And if you look at the range that I made on this chart, we're less volatile than we've been at 2% for the last 25 years. So if the Treasury is spending so much, is this the new normal? I don't see any way that this gets back down to the historical average.
I think it's a new normal. And if they show that it gets down to 2%, it's because we hit a really hard recession here. You know, we're going backwards fast, and so you could easily see this dip back into deflationary if we get into a period like you see back in 2008. If we have a hard collapse of something that has to do with that's interest rate sensitive, that could happen. You know, I'm not going to say that can't happen. Of course it can, but they can't have it. So if that does happen, we'll see the money printer come out, and you won't see $6 trillion printed. We'll see, $16 trillion printed. It's going to be a completely different measure. And so that inflation will rip right back up. Why? Because they need it. We have to have inflation. We cannot have deflation. Think through that for a second. For anybody who wants us to go through a deflationary period, we have $35 trillion of debt right now. 34.5 trillion right now, right? So if we have deflation, how are we going to pay the interest on that? We already have $1 trillion of interest a year on that. How are we going to pay that back? That's what the interest rate is on that debt right now. Well, it could come down if we have zero interest rate policy. We could bring those interest rate payments down, but we're not going to bring down the debt. And so how can you do that without inflation? You need inflation to run hot, to have higher nominal GDP, to have more tax dollars to keep the charade going. If we don't do that, you could see if we go into a recession here, Joe, you'll see entitlements balloon up 10 to 12%, and you'll see revenues collapse 8 to 12%. Or let's call it 8 to 12% both sides. You'll see, 8 to 12% entitlement spending up because of unemployment and all, and medical costs and all that. That'll go in the wrong direction, whereas the income side, tax dollars will go in the wrong direction. So you end up 20% off the mark in a recession. That's super problematic. So I would argue that it's much more likely that we continue to have inflation run around here, and for the Fed to have just enough firepower and ammo in the data to say, we've pretty much tackled it. We don't want to push it, so we're going to back off rates here and let it kind of float between 3 and 4% that they admit to, which is we know is more like 6 to 9%, and so that's the plan. That's what I think the plan is, and best that we can estimate.
So if it is the plan, then how can people listening, what do people listening to this do, right? Do they go take on a new job? Do they start a business? Do they move in with their parents, right? How on earth does the layman, does the average U.S. employed person insulate themselves from this? And also, what's the path forward for the Fed here, I suppose? I guess two separate questions. I'll ask about the Fed afterward.
Yeah. I mean, look, it's not easy for some people. You're working two jobs, you've got kids, you're a single parent. I know some people who have been struggling because this is a difficult economy for some people. This is not easy. It's easy for wealthy people, for boomers, because they're sitting on a lot of assets, and they have enjoyed this asset inflation period, and they haven't really felt the inflation that much. I talked to this past week a number of boomers, and and I don't say that with disdain. They're just with some older people who were kind of surprised that inflation's hurting people. They're like, oh, I didn't realize it was that bad. Yeah, well, it is, and so I do understand that. However, if you have the ability at all to put some money away and to buy things that are long-term stable values, and so I would put Bitcoin in that category. I've had gold. Stocks and bonds they're pretty volatile right now. They're very rich on the valuations. I believe that Bitcoin will be the ultimate store of value. It's the perfect version of digital gold, in my opinion. And so you can buy just a few dollars worth of that, and you can be doing that daily, weekly, monthly, whatever it is, and just buying something that is an asset that will hedge again. And I hate to say hedge against inflation. It's not really. It's just it's opting out of that fiat collapse is what it is. And so that is one thing that I would absolutely advise people to look into. Talk with your advisors. I can't give any individual financial advice because I don't know individual situations. But if you have discretionary income, don't spend it on that. Don't spend it on a name bag or something like that, a brand name, or just put it away. Buy an asset that will appreciate, and hold that through this tough period. That's what you can do. And so you see the people who are doing well now are the ones who have assets. They've got large homes. They've got tons of stocks. They've got big portfolios. They own gold. They own Bitcoin. They own things that are appreciating in value. And so they've been able to protect themselves from this what I think is going to be a great inflationary period.
Certainly seems like it. Certainly seems like it with the way the budget is currently and the path for our debt. Our debt is becoming marginally less effective, so we're going to continue needing more of it. And as a function of that, eventually, too, the Fed will end up stepping in and monetizing it. And I guess to my last question is about financial stability, I suppose. The Fed is now talking about, some analysts are floating that the Fed may begin hiking rates again as a result of where inflation is. If that does happen, how do markets react to higher interest rates? And during an election year, do you think that we've seen now more than ever that the Fed and US Treasury aren't actually separate institutions? The president came out and said that there's going to be a rate cut before the end of the year. What happens in the event that the Fed does hike again?
Well, okay. So first of all, I think that that's a very low probability. Is it not? It's non-zero. It's not that it's zero probability, but I think it's a low probability because what you just said. Because we're in an election year, that would be a massive blow to the administration. It would just signal that we've lost control of inflation, and we've got to raise rates even more. I don't think that's going to happen. If it did happen, it would be because we've had some sort of very large inflationary move, which I can't see what would cause that except for something like a price in energy, a spike in the price of energy, a spike in oil. But if you have a spike in oil, that's likely due to conflict. And so that's not exactly inflationary, So that's uncertainty, and that causes disruptions in markets. So I think that it's unlikely, but if it did happen, it would be because inflation started to really rip higher again and flare up, and so they wouldn't have a choice. But the other reason it might happen is because we suddenly start running $3 and $4 trillion deficits instead of just two, which I don't put past our government. I wouldn't be shocked. Let's put it that way.
It's not too far off. I wouldn't be shocked too. It's tax day, it's tax week, but I highly doubt that the receipts we get are going to be enough. I do think that the deficits are going to grow. James Lavish, thanks for coming on the show. I really appreciate your time. Always fun to chat with you, get the impulse on markets. Where do you want to send people?
Absolutely. Well, it's awesome to be here, Joe, and I appreciate it. People can find me on Twitter, just at James Lavish, and I write that newsletter. It's called The Informationist, and it simplifies one financial concept weekly for people. And you can find that through my Twitter handle, or just go to jameslavish.com. Just sign up, and you can get some free insight there from the world of that I come from.
Fantastic. Thank you, James. And as always, everybody, this show is hosted by Theya, the world's simplest Bitcoin self-custody solution. Visit theya.us or just go to @Theya Research on Twitter, linked in this video wherever you're watching it, and we'll talk to you guys soon. Take care.
Thanks, Joe.